With Brexit, the UK will be leaving the European Union. This means that the City of London, which is Europe's largest hub for the capital markets, non-bank capital and funds management, will be firmly outside of the EU's regulatory purview. In this podcast, we discuss the consequences of this major change, focusing in particular on its policy and market implications, with Dr. Jean-Jacques van Helten, Schumann Visiting Fellow at the Florence School of Banking and Finance at the European University Institute. This podcast was recorded in Florence, Italy in September 2019. Jean-Jacques, thank you very much for your availability to take part in this podcast recorded at the Florence School of Banking and Finance. The goal of this podcast is to shed a light on how Brexit affected the finance industries on the European continent, focusing on one side in particular on the EU and on the other on the United Kingdom. As a former banker, you have dealt with risks and capital markets in Europe and beyond for many years. In the light of your experience and the recent academic research, could you provide a brief snapshot of the financial service market in Europe and explain to our listeners why Brexit is such a major game changer in this scenario?
Thank you very much. Well, let's just sketch the background. London is the home to Europe's largest and most integrated capital market, and it's a major hub for non-bank capital and funds management, and it's based mainly, as we know, in the City of London. The EU is the City of London's biggest customer, with financial services worth 26 billion in 2017-18. Brexit poses very significant policy questions for the EU 27, as it will be after Brexit. Firstly, in respect of how the future capital markets activities within the EU 27 should be managed and regulated, not only in the light of importantly, the light of some in the UK increasingly suggesting a regulatory light, highly competitive oversight regime post-Brexit, or two, whether the EU, in response to this potential reg light regime, should pursue an inward-looking protective strategy to safeguard the single market, or thirdly, whether it should actually boldly open up the single market and seek deeper integration with the global financial markets, including the UK itself. Key point, however, to take away at this point in time is that for Brexit, at least for the foreseeable future, the EU will be in an uncomfortable position, unfortunately, of having no direct regulatory control over the financial market that its economy relies on for access to global financial markets. And I think that's a very critical point to bear in mind.
Now, despite the Brexit vote happened more than 3 years ago, today there is still not a clear picture of what will really happen when and if the United Kingdom will formally cease to be a part of the European Union. However, you highlighted the fact that there have already been many ways in which Brexit affected the European financial industry. Would you like to elaborate a bit more on this, perhaps starting from the very moment of the Brexit referendum in June 2016?
Yeah, I think, within months, if not weeks of the referendum outcome in 2016, I think many in the finance industry began to develop contingency plans driven by the uncertainty of the precise terms of the Brexit deal, if and when it was going to happen, and assuming almost from the get-go that there would be a hard Brexit. And I think that's very important because the hard Brexit assumption was based on two strands of thought. Firstly, that after 2 years' notice, and 2016, of course, since repeatedly extended, the EU treaties would cease to apply to the UK. It would become a third country like any other, and it would no longer benefit from the free movement of goods, services, and people provisions under the EU single market. And that, secondly, on day one of Brexit, the UK will not have equivalent status under the various EU laws, and that it will not have negotiated any bilateral arrangements with individual EU member states for access for its financial services. Now, the key point here to bear in mind is that the UK and any other third country banks operating in the UK have currently got passports under the various directives like MiFID, CRD and the like. And the passporting is a key thing to bear in mind in this discussion. It's critical to ongoing trading and asset management access by the City of London to the EU 27 capital markets and investors.
You just introduced a very important concept, that of passporting. Could you describe what it is and how it is applied to providers of financial services across countries?
So the EU passporting system for banks and financial services companies really enables firms that are authorized in any EU or indeed EEA state to trade freely with any other country with minimal additional authorization. These passports, these licenses to trade in different countries within the EU, is the very foundation of the EU single market for financial services, and it impacts most, if not all, financial activities are currently operating across the capital markets in the EU. And they're based on the single EU rulebook. And they're therefore not available, critically, for countries outside of the EU, like the UK after Brexit. Now, certain EU legislation provides for third country regimes which allow non-EU based firms to offer a limited number of services if their home regulatory regime is accepted as being equivalent to EU standards. And the equivalence is another important concept that we need to bear in mind.
Indeed, equivalence is now crucial to understand how financial services providers will be regulated in the future. So could you specify what being equivalent to the EU standard means in practice?
Equivalence is the idea that if the UK or any financial regulator adopts the same regulatory standards as the pan-European financial regulator like the ECB, then European regulators will continue to allow third country financial firms to operate as they do now in Europe and vice versa. Based around the Joint Committee of the European Supervisory Authorities, national competent authorities, financial institutions and market participants, the EU is recognizing the existing intimate links with the City of London, and consequently it has granted temporary access, this is important, to all EU firms to the clearinghouses, LCH, LME Clear, etc., operating in the UK till March 2020, which is not a long time away from now. Some £40 trillion of swap positions are held by EU banks in London, so that gives you some additional dimension of the importance of the clearinghouses and the connections between the EU and the City of London. ESMA, the European Securities and Market Authority, has also softened its requirements for EU investment firms under the share trading obligation to ensure that trades they undertake in shares admitted to trading on the regulated market or trading on a trading venue in the EU must take place on a regulated market in the EU or third country trading venue that is considered to be equivalent to the regulated market by the European Commission. And this particularly applies to dual-listed stocks like Royal Dutch Shell or Unilever. The equivalence in principle, therefore, seems to be very attractive to the financial industry. So why are non-EU banks not keen? Why is the City of London not that keen on the process of equivalence? Now, the first thing is that although they have been given some flexibility around, for example, this temporary access to the clearinghouses, the EU has in fact been tightening some of the rules on equivalence and to make it tougher for non-EU jurisdictions to gain access. In July of this year, July 2019, the EU, for example, unilaterally removed market access rights for some 5 countries in respect to credit rating agencies. So there is a risk that equivalence can be taken away from you and with it your access to the EU. Importantly, equivalence itself, the rules under that, can be withdrawn by the EU at 30 days' notice.
Absolutely. And taking into account what you just explained with respect to passporting and equivalence, could you outline what will change in practice in the regulatory and business landscape after Brexit?
Well, I think what's happening in the regulatory and in the business landscape is, in fact, that the finance industry, in response to Brexit, has been moving out of London, or moving some of its activities, or in some cases quite a lot of its activities, to alternative EU hubs, to most friendly jurisdictions in terms of capital markets and asset management and the like. And I think that's particularly important because they are trying to ensure continuity of business services from outside the EU. They are transferring some businesses from the City of London to the EU 27. And I think what's happening is that the EU has understood and appreciated that there are significant implications in terms of derivatives and other contract continuity. So there is some flexibility in the time of the EU, but let's not be absolutely clear that unless you have passporting entry into the EU, or you're operating in a jurisdiction which has basic regulatory equivalence to the EU, the access to the EU market will be quite difficult.
And indeed, some of the actions that have been undertaken at the EU level in response to Brexit were conducted to minimize possible risks and ensure continuity in operations. Could you outline the main steps of the process and the major milestones reached so far?
So in the immediate aftermath of the referendum, the shock that was felt with the outcome in London was at least matched within the EU. And as financial institutions in the UK sought to establish beachheads and basically set up offices and subsidiaries across Europe, it became quite clear, at least initially, that a number of countries were quite keen to provide inducements for UK-based institutions to set up operations in their particular country as opposed to another. And this regulatory engagement between the ECB and local supervisors caused some initial friction. And so by 2017, 2018, it was very clear that, for example, there was going to be no regulatory arbitrage. Everything was going to have to be done with input from the ECB to make sure that there was a level playing field when you set up your operations within the EU. And more critically, I think, a number of rules were established that if you move your business to European hubs, your critical functions cannot be outsourced to a third country, i.e. the UK. A clear message from the EU regulators was that you need to have a very clear business model, you have to have local governance, you have to have local policies and procedures. You don't just move an existing business over to the EU, but you need to plan for a long-term future in Europe. And I think that's particularly critical. There was going to be no back-to-back trading, corporate finance, equity raising activities with London. You need to have your representatives and your activities on the ground within the EU jurisdiction. The mind and management was to be within the EU hub centres, not in London. In other words, the critical point is by the Brexit agenda, and I think that's the key point to bear in mind, the Brexit agenda within the EU 27 is set by the regulators. And the banks cannot arbitrage between the different hubs to seek more advantageous regulatory rules. There is a uniform approach across Europe.
And looking at the future, how would you describe what will happen in the next months? Obviously, Brexit will have a great impact on both sides of the English Channel, not only on the role of London as a hub for financial services, but also on the regulation of the EU capital markets.
Yeah, I think the first thing to bear in mind, as we are still awaiting the final day of Brexit, and it may happen in October or it may not, but effectively, as far as the financial markets are concerned, as the finance industry is concerned, Brexit happened a while ago. Most firms have now got their EU 27 plans up and running, certainly by mid-2018. And what was once a plan B, just in case of Brexit, what are we going to do? We're going to stay in London. That has now, with only some activities moving to the EU 27, has now become Plan A. There is a material upscaling of activities by all financial institutions across Europe. Second point to bear in mind is that no single financial centre has dominated these EU relocations, as evidenced by activities like asset management, capital markets, sell-side, etc., moving across multiple jurisdictions. We're moving into a polynodal world whereby there are a number of different financial centres within Europe, all operating under the aegis of ECB and the other EU institutions. By early part of this year, 2019, UK banks have transferred nearly 1.2 trillion of assets to the EU. Insurance companies have moved 35 billion pounds of assets. Asset managers are estimated to have transferred some 65 billion in funds. This is important because it gives some dimension to the progressive multi-year shift of influence for staff, assets, legal entities, etc., start to strip away London's preeminence as a financial centre. This may not happen straight away, but it is inevitable. Beyond the immediate, and the final point I want to make really is that beyond the immediate impact of Brexit, and I'll come back to the policy dilemma of the EU as a final observation, we need to decide, the EU needs to decide whether it wants to keep London at an arm's length, pursue a defensive strategy, enforce equivalence where it sees fit, or alternatively, to open up the EU capital markets to global competition, including from London, to increase Europe's business access to international capital and to boost economic growth. It seems, amidst the glamour right now, the EU is pursuing the former policy response. In other words, keeping London at arm's length, enforcing rules of equivalence and passporting, and not opening up the market globally as well as to London.
And we'll see then in the next few months what will happen.
Indeed.
For the time being, thank you very much for this conversation. It's been really interesting. Thank you for your time.
Thank you.
Thank you. Thank you for having listened to this podcast by the Florence School of Banking and Finance. For more information and to listen to all our podcasts, visit the webpage fbf.eui.eu/podcasts.